Hi, I have tennis in a bit, so I just want to make this video real quick. And because I saw this tweet by Andrew Kang and Veda Research, the basic gist is that they say the best kind of tokenomic design for a project and retail is to have no investors lockup period and have as much tokens to be circulating as possible on day one, except the team and treasury. So Veda Research also said investor tokens should be fully unlocked at TGE. So this is the gist, and the TLDR is that I completely disagree with this. I get the intentions, and I think that works for specific kind of projects, but to say all projects should have everything circulating, no vesting, no lockup, I completely disagree with that. Okay, let's go into details real quick. So, number one, let's talk a little bit. I want to divide this into three. The first one is why, the notion of investors in the space. Number two, just addressing the topic that they talk about, which is unlocking initially and what is the risks and what are the concerns that I have. And lastly is how is this applicable to Web3 and what do I think the kind of models should be. So the first topic is really understanding the notion of investors in the startup space. If you look at traditional IPO, these companies have been around for about 12.8 years. I've done a quick research. For tech companies, it takes about 12.8 years to IPO from start. And these investors basically, it's their lockup period for 12.8 years until it's unlocked at IPO. They sell their tokens. The reason for doing that is because business takes time from a business perspective, right? It takes time to really create value, capture value, and then show the stakeholders, the investors, the value it brings to the table. Then it goes into the public market, and the public takes less risk and purchase the project. In return, they just don't spend so much time holding. They buy the tokens, but they buy the stock and equity at a slightly higher price. And that's okay. This is the risk reward return, which is trading off time for money. It's a lot more liquid, but you don't get as much upside as when you are an investor that invested in Airbnb when it first came out. So IPO, the notion of investors, I believe, in a startup and a company, is that it helps you to bootstrap R&D, it helps you to bootstrap liquidity, bootstrap product development, it helps you to bootstrap your business strategy, because the main point of business is that you bring value to the table. It doesn't matter what your value is, you bring value to the table and people engage with you because they see the value you have. Now let's go to Web3. In the Web3 space, the intrinsic value, the value you bring to the table can be captured in tokens. And this is a whole different topic we can talk about in the future, but the whole notion of a token is that it captures value. Whether your value is speculation, whether your value is utility, whether your value is some form of access to future rewards, access to a community, these are all different kind of value that you can bring and put on the table. They might not always be specifically monetary based, although later down the line it can be, but a token captures value. So when we talk about tokens in Web3, it captures value of this ecosystem. Now, going to point two, which is what my main concern is with the tweet or the notion of of investors having no lockup period, no vesting schedule, just completely circulating at day one. The intention, pros. Let's start with pros. Really good because you find price discovery very quickly. The market, you have everything circulating. You don't have a delay of like 2 years or 3 years and prices dump. If prices were dump, prices dump in day one, and then you find your community, you build with the right kind of users. Some investors might hold, some investors might leave. These are the wrong investors then you attract the right kind of people, you grow with the right kind of people. It's basically user acquisition, and you have a higher probability of user retention because they believe in you since day one. So I get the notion of that. At the same time, I'm concerned about a few things. The first one is really price volatility, right? This is initial sell pressure. And the second thing is short-term focus. The first thing of initial sell pressure is that people don't understand the value that the project brings to the table. These projects, these Web3 projects, and they usually start like 6 months ago. Or if you're maybe a ZK project, you've done R&D and maybe that's about 2 years in working. Whatever it is, 2 to 6 years is still a bit too early to really find PMF, really product market fit, or really to show the value that you can bring to the table. So going back to the notion of, you can attract the best kind of users or the right kind of users first. The thing is, users need to understand what value you bring to the table. If users don't understand what value you bring to the table, then why would they buy the tokens? They are just they're just saying that, this is a brand new token. Maybe I can speculate a little and then sell. They're not going to be long-term focused because they're just seeing this as another meme, another pump and dump token. I'm not saying all tokens are like that. I'm just saying there is this potential possibility, a higher probability that this is the narrative that the token will provide. Also, going back to the notion of investors in this space, investors are here to build with you, to grow with you, to help you with, to bootstrap R&D, to help grow with product development, to help you find PMF. So from an investor's perspective, of course, from an investor's perspective, I think, that'd be fantastic. I buy at 10 cents. When it launches, it usually launches at $2. I just sell it immediately, or I sell my base. Everything else is just pure profits. It goes down, doesn't matter with me. But that's not the point of investors. From a business strategy perspective, investors come in, take on the risk with you, share the risks with you, grow with you, and then exits when they find product market fit. Exits when the business is some level of stability. In my opinion, I believe that's the best kind of business model where you protect the public from having huge volatility and risks, which is one of the roles of investors, in my very, very naive opinion. So I don't think I understand the notion of that, which is finding price discovery early on. I don't believe that there is a lot more pros than cons, because I think there's a lot more risks in liquidating or having all the tokens unlocked and in circulation in the start. It's good for VCs, but I don't think it's good for the project. I don't think it's good for the public. Then comes to the third point. What kind of token models or what kind of business models will make sense? See, I'm not saying that this doesn't make sense at all. I think it makes sense for different kind of business models. So for example, I believe if you're a meme coin, if your intrinsic value comes from the speculative nature of these assets, then 100% go ahead. I think if your value comes from speculation, then you do want circulation initially. You do want no lockup period, because what's the point of having a lockup period? You can build this community, you can build this speculative nature, you can build the narrative, and then the market trends with the cycles, and then the token prices can also trend with the cycles, with the narrative. So I think that's fine. These are typically completely Web3 native, completely Web3 native, quite degen in nature. They might not always be meme coins, but some notion of speculative value attributes to quite a big intrinsic value of the token. On the flip side, there's a different kind of token model, in my opinion, where it's actual business models. These are businesses that bring value to the table. They will take some time to build, some time to capture value. Take Deepin, for example, or L1, L2s, or SocialFi. They take some time to bootstrap community, showcase liquidity, showcase value, find your ideal client profile, kind of figure out how to solve them based on the product that they have. And sure, Web3 can reduce that down from 10 years in Web2 to maybe 2 years in Web3. And, Web3 can shorten the period down a lot. At the same time, you need the investors to be behind you. You need investors to cheering you on. You need investors to be there to help you, to support you while the project is going through the phase of finding product market fit, of finding its first 1,000 users, of finding its community, of finding its loyal users. And there will always be noise around. There will always be speculations around. I believe a good VC should not be part of the noise. A good VC should be part of helping you add value into your system. So that's my opinion. I think that the notion of no investors lockup, completely circulating initially, is very good for investors. I believe at the detriment of the project development and also the public. I think that there should be a lockup period. In fact, that a longer lockup period would be better. Of course, this notion is not popular amongst the VCs community. And so life is all about balance. How do you balance between that? And I'll share more in the next time I share more information. Till then, I'll see you. I'm going to go play tennis. Bye.